All right. Well, I appreciate you taking time out of your morning to come and listen to us today. As always, we're going to end up recording these presentations and making them available if you do want to go back and take a look at some of the numbers, or send it out to people to take a look at this. So what I'm going to end up talking about today is I'm going to talk a little bit about corn and soybean prices, where we're at in terms of old crop. I do want to briefly touch on supply and demand. That won't be the main part of my presentation, but it is important to have an understanding of where we are in terms of both supply and demand in the US on a global standpoint, what the risks potentially are in terms of price reaction as we look at different things. Where I'll spend most of my time is talking about inflation and input costs and how can we bridge that price risk gap, particularly between now and when crop insurance prices for corn and soybeans are determined. So if we think about when our crop insurance prices are determined in Tennessee, for corn and soybeans, it is from February 1st to February 28th. And so for most producers right now, when we look out to the 2023 crop, we actually have very limited protection, if any at all, at this time of the year. But we are, during this time of year, making some of our input purchasing decisions. So again, if we're buying these high cost inputs, is there a way that we can lay off some of that price risk, or at least protect against drops in corn and soybean prices, so that we don't end up getting a catastrophic margin squeeze between now and when we establish our crop insurance prices? So when we look at where old crop prices are, we've actually seen them strengthen. They're down a little bit today, but they remain pretty strong. We'll talk a little bit about some of the benefits of storage. It'll show a couple of slides in terms of what the average returns have been. Some of you will have seen them before, but I think it's really important, particularly in a year like this year, to recognize the importance of having on-farm storage and using that to maximize the prices that you can end up getting. It's been well documented, a lot of the issues we've had in terms of moving corn through the river system because of the low water levels. So again, just having access to that storage, it's not just a powerful marketing tool, but it's a tool to end up assisting in avoiding harvest delays and making sure that you can have a good quality crop as well. And so when we look at where soybeans are, we've been kind of bouncing around between that 14.25 up to 14.75 range on soybeans. So we've had some very strong prices. We all know inputs were very expensive this year. But even with some of our reduced yields, where our state average yield is projected to be right around that 46 bushels per acre, so lower than where we'd end up liking it. There still is some profitable opportunities for producers on the soybean side. When we switch it over to corn's a little bit different. Yes, we've still got very strong prices, but our state average yields are going to be down close to that 130 bushel mark, which is substantially lower than what we'd expect. And that has a couple of different ramifications that I'll talk about in a little bit. But when we look at these prices, yes, they're very strong. We're anticipating there to be strong demand as we move into the new year, just because of the short crop in Tennessee. But one of the other big things for consideration for producers for the 2022 crop is to really sharpen their pencils and see what those crop insurance payments are going to be, because there are going to be some pretty substantial payments based on where the prices were set for crop insurance. We got a bump in the fall price for corn. And so again, I'm not saying that it's going to make everybody whole, but it's going to mitigate a substantial amount of the loss that we experienced in corn in terms of what we were anticipating. So again, very strong prices that are going to end up helping support some of our risk management programs, in addition to allowing opportunities in the new year to further price corn. When we look at average monthly basis, again, this is across states, so it has to be taken with a grain of salt. It's not going to apply to all regions. But we've seen that tremendous drop in basis because of some of the transportation issues on the river. Based on where we are in terms of corn, I mentioned a short crop, 130 bushels per acre. When you have a tighter crop, there's two things that we're likely to end up seeing. We're probably going to end up seeing a strengthening basis in the new year because of reduced supplies, and we'll likely end up seeing additional corn brought in from out-of-state sources to help meet demand, more so than usual. We are a corn deficit state, but that is something that adds another wrinkle in terms of how are we going to move it in here? Are we going to move it up through the barge system, or are we going to move it through rail? And what are the potential implications in terms of moving corn from outside of state to our demand centers in Tennessee? When we look at soybeans, even more adversely affect. We all know that we don't have much in terms of in-state crushing. We do send some up to southern Illinois and some down into Alabama and Georgia. But at the same time, we were really adversely affect in terms of basis. So being able to store and end up looking at hopefully having some basis improvements between now and January through March, I think is something that we could end up anticipating for those that have access to storage. Now, there is one that we'll talk a little bit on the supply and demand side of things that is kind of maybe a potential warning with the size of the Brazilian crop, where they'll be exporting to global markets in end of January all the way through April and May. And so if we run headlong into the competition of the South American markets, we could see some softening in terms of overall prices. A lot that's going to be contingent on the size of the South American crop. When we look at storage returns, again, I've showed this slide several times, but I don't think I can emphasize the importance of having on-farm storage. It's something where historically, and this is on average, if you store it until May, you're getting 84 cents a bushel above what the harvest low is for corn, and for soybeans, you're getting $1.23. So again, when you're looking at having those discussions about marketing tools, I think this is one that is very important to end up having that discussion. It doesn't come without costs, but there are some really strong benefits for Tennessee producers to evaluate where their storage is and being able to take advantage of some of these price improvements over time. When we look at kind of an updated supply and demand situation, I put a fair number of numbers up on here because I did want people to be able to make the comparisons over the last 10 years as to where we are in terms of production, use, ending stocks, days on hand, and marketing your average price. So this is for global corn, and there's a couple of numbers I just really want to quickly point out. The first one is days on hand. That is the amount of stocks that we have relative to average use. And so we have right now 93 days of stocks on hand, and you can see where that falls relative to past years, where we kind of peaked back in 2016, then we've come back down. And so the takeaway from this slide is that we do have very tight stocks relative to global use, and that's why we're seeing prices estimated for the 2022-2023. This is a national marketing year average price of 680. So we are projecting very strong prices for the 2022 crop as we enter into the new year. Now, there are a couple of things out there that we all know that futures markets have been incredibly volatile over the last year and a half, but there are certain things, obviously Ukraine, Russia, with a missile going off in Poland. There's the potential for that to be amplified. South American second crop corn production is another one to keep in mind. Their first crop really isn't substantial for corn production, so what really matters is how quickly they can get that soybean harvest completed in January and February, because they'll plant corn right behind that, and that's the harvest that will really be in competition with in the summer and into the fall of 2023. And then where are we going to be in terms of planted acreage in 2023? I'm going to talk about input prices. It doesn't look like they're going to come down substantially, and there's some warning signs in terms of what we're potentially looking at there. So where will we end up being in terms of planted acreage is a big uncertainty. When we look more specifically at the U.S. supply and demand situation, we see a similar picture. Only when we look at that number of days on hand, we're projected pretty close to where we are back in 2020, which was a low over the 10-year period. And again, we're seeing very, very strong prices there. The one thing that is a little bit uncertain at this point is this export sales number. We're lagging pretty substantially behind where we should be at this time of year. There's still plenty of time in the marketing year because it goes all the way to August 31st. But this export number, I think, is the number one number I'll be watching in terms of where that will end up being, because it'll have a direct correlation to what we have in ending stocks on corn. But again, the takeaway from the corn supply and demand side of things, we're anticipating strong prices as we move into the new year, because we do see, some pretty limited stocks relative to what we're using. Obviously the global economy is going to play a role in that, but as of right now, we are anticipating corn prices to remain strong for the old crop, and we'll have to wait and see for new. When we look at world soybean stocks, this is where things are a little bit different. Two numbers that really jump off the page to me is when we look at these production and use numbers. Yes, when we look at the stocks and we look at days on hand and marking your price, that's important. But look at the jump in some of this estimated production. And a lot of that is going to be driven out of Brazil. And we know that there's still a tremendous amount of uncertainty out there. But what we do know is that they're anticipated to have record plantings in Brazil, and their growing conditions so far have been average to above average right now. Now that can end up changing. Argentina's down a little bit. They're in the midst of a drought. So again, we'll have to see where these final numbers are. So on the production side, we're estimating that or USDA is estimating it up. On the demand side or the use side of things, it's actually pretty substantial increase in demand too. And so there's some real positives in soybeans in terms of the demand side. The big uncertainty or where we're going to see potentially driving price reaction is what's going to happen down in South America. We have seen stocks creep up a little bit relative to the past 2 years, but at 98 days on hand, I would still make the argument that we're sitting in a pretty good set of circumstances, but the big risk is what's going to happen down in South America. When we look at U.S. soybean stocks, again, this is one that's very tight. Our biggest challenge is accessing those export markets and making sure that we can export our commodities out through the river system. Another one that is worth watching, and there's been several articles that have been out on this, is the increased domestic crush coming online in 2022, 2023, and 2024 has the ability to really change some of our soybean markets. So that's one that is important to continue to monitor as we end up seeing a lot of these crushing facilities come on. And a lot of that is driven by the renewable energy market for biodiesel. But again, it's something where I think the latest estimate I seen was about 650 million bushels of capacity coming online for soybean crushing. Now I want to switch it up to what's going on kind of on the input side of things. And you really, need to end up looking at where we are in terms of interest rates and inflation. This goes all the way back to 2018, where it shows the bank prime rate and the monthly inflation rate. And what we've seen is inflation month over or year over year start to come down after it peaked back in May, where we're at 7.7% right now. And a lot of that has been driven by increasing interest rates. And so when we think back at the start of the year, we had a prime rate of about 3.25%. We're over double that now. And so again, that completely changes what we're anticipating in terms of interest expense and potential access to credit. Now, again, the challenge that we're running into is that this is not just a monetary driven inflation. There's a bunch of things embedded in energy prices and supply chains. Yes, the amount of money that went out through government programs definitely increased inflation substantially, but we still have supply chain issues and energy prices, which are going to make it sticky for inflation to come down dramatically without having a recession trigger. So this is something that remains a very challenging set of circumstances to end up managing in terms of how do you bring inflation down without triggering a longer term or deeper recession. And that's going to be something where it's going to be really challenging over the next 6 months for this not to end up having some adverse consequences in the economy. This is a slide I got from Andrew Muhammad. But I think it's important, and again, I don't want to be an alarmist, but at the same time, diesel is a challenging one right now. We're at the lowest level of inventory for this week in 40 years. You can see the range and where we're at. And so when we're thinking about planning for the 2023 crop and what our diesel needs are for the remainder of this year, I think it's really important to have those conversations, see what your price expectations are, and make sure that you are making arrangements to have enough diesel for the upcoming year. When we look at fertilizer prices, we've seen them peak and then they came back down. What we're hoping to end up seeing is a further reduction. When we look over here on the MAP, DAP, potash and urea side of things, unfortunately, the transportation issues on the Mississippi River is not going to help this set of circumstances. Bringing product up the Mississippi River, in addition to going down, creates the potential for some higher prices. But I guess the bottom line is, when we're looking at this, based on diesel availability and based on fertilizer prices, I think we're probably going to still be in that high input cost environment as we make it into 2023, and we could even see a potential increase in some of these costs as we enter the new year. I mentioned the importance of interest rates. I took just a real basic example here of having a 1.25 million operating loan and what the ramifications are with these interest rate increases. If you take 3.25%, that budget into roughly around 11.06%, or $11.06 per acre. When we're at 7.5%, that more than doubles. So we're $25.68 an acre. It's not an insignificant increase in cost. So again, making sure that you have access to appropriate financing and try to minimize those interest expenses is something that is worth taking the time to secure this fall. So when we look at kind of a summary for what will it cost to produce a crop in 2023, I think we're still going to have input purchase timing and availability issues. I think costs are still going to be elevated. I'm not sure if we'll be at the same levels as last year, but I wouldn't anticipate them coming down, and there is still some upside risk on that. Financing charges are definitely going to be substantially higher than last year, so that needs to be budgeted in there. We've had several discussions on land costs. I think there's going to be an expectation that our cash rental rates will end up increasing. Those that are on crop share are already looking at higher costs for 2022. So this needs to be factored in when we're looking at our budgeting approach. Now, I know everybody's cost of production is different, but if we're looking at kind of a reasonable estimate in terms of all in, the range that we've kind of been working with is for 170 bushel per acre corn is somewhere in that 750 to 1,000. There will be substantial number of people that'll be on the high or low end of that, and some people will fall outside that range. But this is just an estimate that we're looking at for 2023 for 50 bushel being somewhere between $400 and $700 an acre. Again, tremendous amount of variability, but these are some starting points when we look at budgeting for the 2023 crop. So when we look at right now, I mentioned the vast majority of producers are not going to have any price or revenue protection until we get into the crop insurance determination period. And so when we look at where the December and November contracts are, corn was at 626 at close last night, and soybeans were at 1397. Those are pretty strong prices when you look at historically. I'm not saying to lock in those prices. There's a huge difference between price protection and locking in a price. And so what I want to step through is an option scenario that can be beneficial to bridge the gap right now in price protection when you're purchasing inputs to when you end up establishing that crop insurance price. So if you're targeting those typical state averages, 175 to 150 bushels per acre, what's your projected revenue at the current price offerings? This doesn't account for any basis, so you'd have to end up putting that into the calculation as well. But when you look at corn, that's 1,095 per acre and 699 per acre for soybeans. So again, when we look at those production costs, even if we're on the high end side of that, there's some black on the table there. So it's one of those ones where we might want to look at protecting some of that price that's available, because we know that there's a tremendous amount of volatility and uncertainty in commodity prices that could end up pushing this lower. So when we look at the projected cost of production, what does that look like in terms of a break-even price? And the simple way to end up calculating this is you take your corn cost of production, divide by what your target yield is. And that's going to give you a break-even price of $5.71 for corn and $13 for soybeans under these cost assumptions. So again, if you're working through it with a producer, or if you're working some of your numbers, to get to that break-even price, I think is really important, because that's where you can kind of really look at, okay, where should I set some of this price risk protection? And so based on those break-even prices, I looked at what was going on in the option market for both the December 2023 corn contract and the November corn contract. I looked at puts. And so the strike price I chose was 570. So it's out of the money based on where current price offerings are. The premium's 35 cents. So that builds a 535 floor. Soybean strike price is 13, premium is 54, and the floor of 1246. I think that you can make the reason why, and Andrew always says you never want to sell something below your cost of production, but I think one of the benefits that you can make in protecting something in the futures market is because we have strong historic basis within the state, we can make up some of that, those prices through just marketing and storage, and the strong basis that's available in Tennessee. So how this would end up working conceptually is you ended up buying that put option and carrying it until we ended up having our crop insurance prices determined in February, by the end of February. And so if you end up having December corn and it's trading above 570, your option is not in the money, so you exit and you recover a portion of the 35-cent premium. And I would make a wager that you would be able to recover a pretty good chunk of this premium based on the time value that's still embedded in that option contract. And so again, I know one of the biggest things that producers always bring up when I talk about options is they're expensive. They're expensive if you carry them until the end of expiration of that option. What I would propose is you time it so that you can end up recouping a substantial portion of that premium for covering the risk that's associated with a very defined time interval. If you have the December contract below 535, well, then you're in the money and you'd maintain that position. You have an added price level of protection in addition to whatever you end up getting when the crop insurance prices are determined. And so when we look at this, I think the take home is here is it provides a low cost price protection option until your crop insurance is determined. There's limited risk here. Yes, it may cost you a few cents per bushel, but I think it's something that's worth considering given the volatility and uncertainty that we see in futures markets. Very similar thing with soybeans. I would argue that for soybeans, it probably makes more sense just because of the high degree of uncertainty because of South American production. But again, if you're seeing recovering part of that premium and end up looking at, okay, well, if I'm in the money, well, then great, I maintain that position. But it's all about how do you end up bridging that price risk gap. So when we look at this, options are a very powerful tool. It doesn't lock you into a price. If you start hedging or if you start doing cash forward sales, you've established a price on that protection or that production. So this gives you a way to end up protecting against dramatic price declines until we get additional protection that's provided by crop insurance on March 1. I think there's a very strong possibility that you would recoup the majority of the premiums under both of these strategies. And if you are in the money, well, then you've protected against that price and you've established a futures price floor for production that until you make additional sales. So just in closing, input prices are high and they're likely to remain high into 2023. I think timing is going to be important. You're going to have producers evaluating where they are in terms of prices when it's going to be beneficial to end up making some purchases. And if they can get a deal, I think there's going to be a tremendous amount of variability in what the average price for fertilizer and diesel is going to be between operations. So actively seeking out those opportunities, I think is important. I do think we need to remove some financial risk. I'm very concerned about a margin squeeze where we end up having high input costs, and then when we turn around to sell our commodities, prices have pulled back, and we've got negative margins that could get us into financial difficulties. There's still going to be tremendous volatility in the commodity markets. There's just so much going on that is outside of our control on a global and national scale. And so when we're looking at, okay, we have no control over what's going on in terms of prices on the futures market, but you do have the ability to manage that price risk. And so, I think this is something that's important to have conversations about. How do we manage our price risk at certain points in the year, and then deferring kind of those final sale opportunities to when we know more about what our production is looking like, what our acreage is looking like, and, evaluating where we are down the road. This is a method. Using these options to bridge the price risk gap is a method to buy time before you have to make final decisions or additional decisions about pricing commodities.